Investing in low-cost index funds is a popular strategy for both beginner and seasoned investors. It's a form of passive investing where you aim to mirror the performance of a specific market index. If you're new to the world of investing, this concept might seem daunting. But don't worry, we're here to help. Let's break it down step by step. Understanding what an index fund is. An index fund is a type of mutual fund or exchange-traded fund ETF, with a portfolio constructed to match or track the components of a financial market index, such as the Standard & Poor's 500 index. Essentially, an index fund aims to replicate the performance of a specific market index. The fund does this by holding all or a representative sample of the securities in the index it tracks. The goal isn't to outperform the index, but to mirror its activity. Because they're not actively managed, meaning a fund manager doesn't make decisions about which individual securities to buy or sell. Index funds typically have lower costs than actively managed funds. Recognizing the benefits of index funds. Index funds offer several benefits. First, they provide diversification, which is crucial in investing. Each fund can include hundreds or even thousands of different stocks or bonds, which can help to spread risk. Second, they're cost-effective. The passive management style of index funds often results in lower expense ratios compared to actively managed funds. Lower costs mean more of your money goes towards your investment. Lastly, index funds generally have lower turnover, the selling and buying of assets within the fund, which can result in fewer taxable events, potentially making them more tax efficient. Identifying your investment goals. Before investing, it's important to identify your financial goals. What are you saving for? Retirement? A down payment on a house? Your child's education? Or perhaps something else? Your goals will influence which index funds are most appropriate for you. For example, if you're saving for retirement and have a long time horizon, you might consider a stock index fund. But if you're saving for a short-term goal, a bond index fund may be more appropriate because it carries less risk. Choosing the right index fund. There are many different index funds to choose from. Some track large cap indexes like the S&P 500, while others track small cap indexes, international indexes, or sector-specific indexes. Your choice will depend on your risk tolerance, investment goals, and desired level of diversification. For example, if you want exposure to the entire U.S. stock market, you might choose a fund that tracks a broad index like the Wilshire 5000. If you want to invest in international markets, you might choose a fund that tracks a global index. Opening an investment account. To invest in index funds, you'll need to open an investment account. This could be a brokerage account, an individual retirement account (IRA), or a 401k through your employer. Each type of account has different tax implications, so it's important to understand these before deciding where to hold your investments. For example, contributions to a traditional IRA or 401k are tax deductible, but withdrawals in retirement are taxed. On the other hand, contributions to a Roth IRA or Roth 401k are made with after-tax dollars, but withdrawals in retirement are tax-free. Purchasing the index fund. Once your account is open, you can purchase your chosen index fund. Look up the fund's ticker symbol, decide how much you want to invest, and place your order. Most index funds can be purchased with a simple market order, which buys the fund at its current price. Some funds may have a minimum investment requirement, so be sure to check this before investing. Regularly investing. Regularly investing a set amount of money is a strategy known as dollar cost averaging. This approach can be beneficial because it allows you to spread out your purchases, potentially reducing the impact of short-term price volatility. By investing a fixed amount on a regular schedule, you buy more shares when prices are low and fewer shares when prices are high, potentially lowering your overall cost per share over time. Monitoring your investment. While index funds are designed to be set-it-and-forget-it investments, it's still important to monitor your portfolio periodically. This doesn't mean checking it every day. Once or twice a year is usually sufficient. You want to ensure that your investment is still aligned with your financial goals and risk tolerance. If your circumstances or goals change, you may need to adjust your investments accordingly. Investing in low-cost index funds can be a straightforward and cost-effective way to grow your wealth over time. Remember, all investments come with risk, and it's important to do your research. And consider seeking advice from a financial advisor if you're unsure. The key is to start investing early and regularly, remain patient, and let the power of compounding work in your favor. Investing is a long-term endeavor, but with patience and discipline, it can be a key part of achieving your financial goals.